Whitecap Resources underwent a fundamental shift in May 2025, transitioning from a story of organic growth to one of transformative scale. The acquisition of Varen for approximately $15 billion, including the assumption of net debt, stands as the most significant event in the company's corporate history, propelling it to the status of Canada's seventh-largest oil and gas producer. This amalgamation was not merely a pursuit of volumetric expansion, but a calculated effort to high-grade the company's inventory, focusing on the condensate-rich fairways of the Alberta Montney and the high-deliverability Kaybob Duvernay. As the industry assesses the company's performance heading into 2026, the primary point of contention for market participants involves the sustainability of its high payout model against the backdrop of volatile commodity prices and a tightening regulatory environment in the Canadian energy sector.
The bear case for Whitecap is dominated by macroeconomic sensitivities and the potential for regulatory-driven production constraints, commodity price sensitivity, and funds flow risk. The company remains one of the most price-sensitive entities in the Canadian energy space. According to management sensitivity analysis for 2026, every US $1 change in the price of WTI impacts the company's funds flow by $50 million. Similarly, every 10 cents change in the AECO gas price impacts funds flow by $20 million. In a scenario where WTI averages below US $50 per barrel for an extended period, the company's ability to maintain its growth capital and its high dividend would be severely tested, potentially leading to a significant reduction in the share price. Integration and execution complexity. While the integration of Varen has been successful thus far, the sheer scale of the 2026 production target, reaching exit rates of over 380,000 BOE per day, carries execution risk. The aggressive ramp-up in unconventional drilling requires a constant stream of high-quality labor and equipment in an environment where the Western Canadian Basin is already highly utilized. Any operational stumbles or infrastructure bottlenecks could lead to a miss on production guidance, which the market historically punishes severely.
Regulatory and emissions mandates. The Canadian federal government's climate agenda remains a significant long-term risk for upstream producers. The proposed oil and gas emissions cap aims to cut sector emissions to 27% below 2026 levels by 2030. While the company is a leader in carbon capture, the cost of implementing these technologies across its vast unconventional acreage could be substantial. If the company is unable to meet these mandates through technical abatement, it may be forced to purchase carbon offsets or, in an extreme scenario, curtail production. Furthermore, while the federal fuel charge was removed in April 2025, the industrial carbon pricing system remains in place and is set to increase by $15 per ton annually until it reaches $170 per ton in 2030. This rising cost of carbon acts as a permanent headwind to operating margins. The bull case, catalysts for equity re-rating. The fundamental bull case for the stock rests on the premise that the market has not yet fully priced in the long-term value of the Varen merger and the company's ability to replace production at low costs.
The primary catalyst for a further re-rating is the continued outperformance in synergy capture. By raising its 2026 synergy target to $300 million, the company has effectively improved its capital efficiency by 10% compared to original pro forma estimates. If the organization can continue to drive down unit operating costs, which reached $12.24 per BOE in late 2025, it will widen its margins and increase its free cash flow per barrel at every point on the price curve. Reserve replacement and inventory depth. With a record 2.2 billion BOE of 2P reserves, the company possesses a reserve life index of 16 years. This long-duration asset base is a significant competitive advantage in a sector where many producers are struggling with inventory depletion. Furthermore, only 21% of the company's unconventional locations are currently booked in the 2P category, leaving substantial room for future organic reserve additions as more of the 1.5 million acres are de-risked. Natural gas price diversification. Although the company is primarily a liquids producer, its natural gas volumes are substantial, ranking it as the fifth largest gas producer in Canada. To mitigate the risks of the historically volatile AECO market, the company has aggressively pursued a price diversification strategy. By 2026, the company will have a second 10-year agreement to deliver 35,000 MMBTUD of natural gas to the Chicago hub, priced at NYMEX Henry Hub less deductions. This strategy aims to move 50% of the company's gas pricing outside of AECO, increasing exposure to more stable and higher-priced markets.
Company Deep Dive. The Varen Combination, Mechanics and Strategic Imperatives. The completion of the Varen transaction on May 12, 2025, served as the primary catalyst for the company's re-rating in the eyes of institutional investors. By integrating Varen's assets, the enterprise secured a dominant footprint in the Alberta Montney and Duvernay regions, totaling approximately 1.5 million acres. This acquisition instantly made Whitecap the largest landholder in the Alberta Montney, a position that provides an unparalleled runway for organic development. The strategic rationale was driven by the desire to increase the liquids weighting of the production mix, while simultaneously improving the capital efficiency of the drilling program. The immediate impact of the merger was visible in the production metrics for the latter half of 2025. Fourth quarter production averaged 379,606 barrels of oil equivalent per day, representing a 115% increase over the same period in 2024. More importantly, the funds flow per share remained resilient at 72 cents per quarter, despite a significantly weaker commodity price environment. This resilience suggests that the structural improvements in the cost base have begun to insulate the bottom line from the inherent volatility of the WTI benchmark.
The company's strategic asset classes are now categorized as follows. Alberta Montney, approximately 1 million acres focused on light oil and condensate, with over 5,800 inventory locations. Kaybob Duvernay, approximately 535,000 acres, focused on liquids-rich gas, with 4,700 combined inventory locations across the unconventional portfolio. Saskatchewan Conventional, mature assets focused on low-decline oil, with 7,000 inventory locations. Total corporate footprint, over 1,500,000 acres across a diversified basin, with a total of 10,500 inventory locations. The synergy realization following the merger has been a standout feature of the 2025 fiscal year. Management originally targeted $210 million in annual savings, a figure that was viewed as ambitious at the time of the announcement. However, by the end of 2025, these estimates were revised upward to $300 million for the 2026 budget cycle. This 40% overperformance in synergy capture is attributed to several factors, including rig line optimization, where the company utilized its increased scale to secure dedicated high-performance rigs at lower effective rates, and procurement efficiencies across the expanded supply chain.
The company's growth strategy for 2026 is heavily weighted toward its unconventional division, which is slated to receive approximately 75% of the total capital budget. The Montney and Duvernay plays represent the high-impact growth engines of the portfolio, and the 2025 drilling results have provided significant validation of the company's subsurface technical models. Montney manufacturing and bench development. In the Alberta Montney, the company has transitioned from a period of delineation to one of factory-style manufacturing. The 2025 drilling program focused on core infrastructure-supported areas such as Elmworth, Carr, and Kakwa. A critical technical breakthrough occurred at Northwest Kakwa, where the company successfully brought on its first triple-bench Montney pad. This 3-well pad achieved an IP90 rate of 1,212 BOE per day, with a 65% liquids weighting, outperforming original type curve expectations by 14%. This success confirms the viability of developing multiple vertical intervals simultaneously, which significantly improves the net present value of each surface pad. The Montney strategy is also defined by commodity optionality. Because the Montney reservoir varies in its gas-to-oil ratio, GOR, across the company's vast acreage, management can shift capital toward light oil and condensate-rich targets during periods of high oil prices, or pivot toward lean gas development if natural gas prices and egress options improve. This flexibility is a key differentiator against more focused peers and allows the company to maintain high returns through various market cycles.
Duvernay wine rack optimization. The Kaybob Duvernay has emerged as one of the most capital-efficient assets in the Western Canadian Sedimentary Basin following the implementation of the wine rack drilling design. This methodology involves staggering horizontal laterals in a three-dimensional pattern to maximize reservoir drainage while minimizing interwell interference. In 2025, the company brought on its seventh wine rack pad, with subsurface data indicating substantial improvements in per-well estimated ultimate recovery. Operational efficiencies in the Duvernay have also reached new heights. Drilling speeds in the region improved by approximately 20% year-over-year, with a recent pacesetter pad drilled at a rate of 600 meters per day. Additionally, real-time fracture monitoring and the refinement of completion parameters, such as perforation cluster spacing and pump rates, have reduced average completion times by 8%. These gains are essential for offsetting the inflationary pressures that have plagued the oilfield services sector in recent years. Conventional portfolio, the foundation of cash flow. While the unconventional assets drive growth, the conventional oil plays in Saskatchewan and Alberta provide the low-decline production base necessary to fund the company's high dividend yield. These assets are characterized by mature waterflood programs and have a combined decline rate of less than 20%. A significant technological advancement in the conventional portfolio has been the deployment of extended-reach open-hole multilateral wells. In the East Saskatchewan Bakken, the company drilled its first 3-mile, 8-leg OHML well, which achieved an IP90 rate 38% above expectations. This drilling technique allows for maximum reservoir contact with minimal surface disturbance, significantly improving the capital productivity of mature fields.
In the Frobisher play, 2025 results were equally impressive, with wells reporting IP18 rates that exceeded expectations by 41%. The ability to apply modern drilling and completion technologies to conventional assets has revitalized these older fields, turning them into reliable generators of free funds flow that support the broader corporate capital allocation strategy. A comparison of operational metrics between the two divisions highlights the portfolio's balance. Unconventional assets, slated for 75% of 2026 capital allocation, focuses on a liquids-rich gas and condensate production mix, utilizes a high-intensity manufacturing development style, and achieved a 20% drilling speed improvement in 2025. Conventional assets, slated for 25% of 2026 capital allocation, focuses on a light and medium oil production mix, utilizes enhanced oil recovery development styles, and achieved a 38% IP90 outperformance in 2025. Financial strategy and shareholder return framework. The company's financial framework is designed to provide a total shareholder return target of 10 to 15% annually. This return is comprised of a stable and growing base dividend, production growth per share of 3 to 5%, and opportunistic share repurchases. The 2025 fiscal year demonstrated the effectiveness of this model, as the company delivered a 15% total return despite a lower commodity price backdrop. The monthly dividend of $0.0608 per share, or $0.73 annually, remains a primary draw for income-focused investors. In 2025, the organization distributed $736 million in base dividends, a figure that was well covered by its $900 million in free funds flow. Management has expressed a commitment to maintaining a sustainable payout ratio, targeting 20 to 25% of funds flow for the base dividend, which allows for continued reinvestment in growth even in a $60 WTI scenario. In addition to dividends, the company utilized its normal course issuer bid to repurchase approximately $193 million in shares during 2025, effectively reducing the share count by 2%. The 2026 capital budget of $2.1 billion is designed to be fully funded at US $60 per barrel WTI. At this price level, the company projects approximately $3.3 billion in funds flow, leaving ample room for both the dividend and further share buybacks or debt reduction. If commodity prices strengthen to US $70 per barrel, the company's capacity for buybacks and debt reduction could increase to as much as $800 million. This counter-cyclical approach to capital allocation ensures that the balance sheet remains strong regardless of the price of oil. Balance sheet management and credit profile. Whitecap maintains an investment-grade credit rating of BBB from DBRS, reflecting its conservative leverage and significant liquidity. As of December 31, 2025,
Net debt was approximately $3.4 billion, which corresponds to a net debt to funds flow ratio of less than 1x based on annualized fourth quarter results. The current debt profile includes the following components: total net debt, December 2025, $3.4 billion. Available liquidity, $1.5 billion. Cost of debt, average of approximately 4%. The company's debt structure is well balanced, with approximately 50% of its net debt held at fixed interest rates. This provides protection against rising interest costs, while the remaining floating rate debt allows the company to benefit from future rate cuts. The maturity profile is laddered, with 4 major issuances of investment-grade notes maturing between 2028 and 2034. For 2026, the company plans to use its credit facility, which has $1.5 billion in unutilized capacity, to address maturing private placement notes. This strategy minimizes refinancing risk and maintains high levels of financial flexibility.
Macroeconomic egress, TMX and Coastal GasLink impacts. The outlook for Western Canadian energy has been significantly improved by the completion of major infrastructure projects, which have narrowed the pricing differentials that historically plagued the basin. Trans Mountain expansion. The TMX project, which came online in May 2024, nearly tripled the capacity of the Trans Mountain system to 890,000 barrels per day. This added egress has effectively eased the constraints on Western Canadian crude, leading to a narrowing of the WCS-WTI differential from nearly $19 per barrel in late 2023 to approximately $12 per barrel in 2025. For a producer like Whitecap, which produces significant volumes of medium and light oil that are priced relative to these benchmarks, the TMX has provided a more stable and higher realized price for its barrels. Coastal GasLink and LNG potential. The Coastal GasLink pipeline, now operational, connects the Montney Shale formations to the LNG Canada export facility in Kitimat. This project represents the first major path for Canadian natural gas to reach global markets. For the company's Montney and Duvernay assets, the commencement of LNG exports is expected to provide a long-term floor for AECO prices by removing excess supply from the domestic market. This macro tailwind is a critical component of the bull case for the company's gas-weighted unconventional expansion.
Competitive peer analysis. The comparative landscape of the Canadian energy sector is as follows. Whitecap Resources, market capitalization of approximately $17 billion, PE ratio TTM of 14x, and a net margin of 18.4%. ARC Resources, market capitalization of approximately $14 billion, PE ratio TTM of 12x, and a net margin of 21.0%. Tourmaline Oil, market capitalization of approximately $24 billion, PE ratio TTM of 18x, and a net margin of 27.6%. Whitecap's ROE of 10.14% beats Tourmaline's 8.30%, although ARC Resources remains the most profitable on an ROE basis at 15.52%. The high dividend yield of 5.3% is one of the most attractive in the sector, significantly outperforming Tourmaline's 2.9% and ARC's 3.4%. Conclusion. The bull case, driven by the immediate accretion from the Varen combination, a synergy program that is delivering $300 million in annual value, and a world-class inventory of 10,500 drilling locations. The company's technical prowess, evidenced by its wine rack designs and 3-mile OHML wells, has lowered its break-even costs and improved its capital productivity to industry-leading levels. However, the bear case highlights significant risks that cannot be overlooked. Whitecap's massive leverage to oil and gas prices makes it a high beta play on the global economy. Any sustained price collapse would threaten the dividend and force a sharp reduction in capital spending, potentially halting the company's growth momentum. The looming federal emissions cap and rising industrial carbon taxes represent a permanent regulatory headwind that will require ongoing capital investment to mitigate.